Picture this, a company sells a product that keeps getting cheaper. The headlines say the price is falling, the internet says the hype is fading, but then the company reports a quarter so big, it barely fits on the screen. 617.8 million in revenue in one quarter, up 28% year over year. So you ask the obvious question, how does that happen and how do you grow like that while the main product is getting cheaper? And the answer is why I think most people still do not understand what Hims is actually building, because Hims is not selling one thing. Hims is building a library, and once someone subscribes to the library, you can keep giving them new reasons to stay. That is the Netflix playbook, and Hims just said the quiet part out loud. On their earnings call, the CEO compared what's happening in healthcare to what Netflix and Spotify did in entertainment. That is not a cute line. That is the blueprint they are following. On this video, I'm going to show you the real model behind Hims's growth. We'll start with the hard numbers from Q4 and full year 2025. Then we'll talk about why every Hims category tends to follow the same pattern: fast growth, then slower growth, then a new product wave shows up and growth speeds up again. Then we'll connect all of this to the framework I believe it's following that Netflix has done. We're going to be citing direct quotes from the earnings call and shareholder letter, plus the maths behind why revenue can rise even if one category gets cheaper. And at the end, I'll lay out a realistic scenario for how this kind of platform can become a much bigger company in the next 3 years without pretending anything is guaranteed. Because if you listen to anyone online and they are guaranteeing stock prices or results, you need to stop listening to them and you need to look at things more objectively. And that's what we do here. Let's get stuck in.
Welcome to the game, it's the Instant Stocks by Mikhail Kuhar.
And if you don't know who I am, my name is Mikhail and I'm a partner at X10 Day Trade, where we have a team of professional traders that can trade for you. I want to show you our results just this week, in the last 3 days this week. So yesterday we took a trade with Coin as it had a very strong setup, and we're actually able to generate our members 61% return on this trade. This is completely hands-off. Our software plugs into interactive brokers on your behalf and trades for you. The day before, Palantir, we saw a 23% return. The day before that, QQQ, we saw 9% return, and Palantir 7% as well. And you can see our results over the last 6 months. September 12.9, October 8.5, November 3.4, December 4.2, January 5%. We had a 73.8% trade win streak. Look, I'm showing you all this because we talk about these trades. We're sharing everything we're doing inside in real time as we're taking these trades. Now, we saw a massive problem in the market where people either don't have time or they don't have the skills to leverage in the market to be very successful at day trading, which is why we built the software that allows our team to trade for you. If you want to find out more, go to x10daytrade.com or click the link below. Book in a call with myself and I'll walk you through the entire system on how we do that for you, where we get 5 to 15% returns every single month. Let's get into the video. So let's look over the facts. Hims reported Q4 2025 revenue of 617.8 million, which is up 28% year over year. For the full year in 2025, Hims reported 2.3 billion in revenue, up 59% year over year. They ended 2025 with 2.5 million subscribers, up 13% year over year. And here is the metric that tells you this is not just a more customer business. The monthly revenue per average subscriber was $83 for the full year of 2025, up from $65 in 2024, which is a 28% growth. These are some big numbers, and there's some consistent numbers across the board. This is a platform signal, because if this was a one-hit product company, that number would not rise like that. In a one-hit product company, you grab customers, they leave. That's it. They came for one thing, they got what they needed, they're out. Or you have to keep spending more to replace the churn of customers. But when monthly revenue per subscriber goes up, it usually means one of three things. People are staying for longer, people are buying more, or the company is getting better at matching people with higher value care. Sometimes it can be all three. Every time I'm working with a business, which I've worked with hundreds of businesses over the years, these are some numbers I look at with every single business I work. We're looking at CAC. CAC, which is customer acquisition value, is essentially how much do you need to spend to acquire a customer. And now if we look at Hims, in 6 to 7 months, they usually recoup their acquisition costs. So the three key things are looking at customer acquisition costs, average monthly spend, and then LTV, which is the lifetime value of the customer. So on average, how much are they spending? How long are they staying with us? And you figure out the lifetime value of the customer. Hims are improving all of these metrics, which is really, really exciting to see. And they can be doing this in quite a few different ways. But sometimes the three I mentioned before, it can be all three, or it can just be one of them really, really well. So if we talk about the falling product part, because that's the hook everyone cares about. On the earnings call, Andrew Dudham said this about GLP-1s. He said US prices for injectable GLP-1s have fallen more than 80% over the last 18 months. So if your brain is trained to think like a normal product business, you would assume that should hurt revenue, because price down usually means revenue down. But Hims is not built like a normal product business. Hims is built like a subscription platform that keeps adding new doors into the same house. That is why falling price is one category that does not automatically kill growth. In fact, sometimes it can do the opposite. If something gets cheaper, more people can afford it, more people can try it. The top of the funnel just gets wider, and you start to appeal to a wider addressable market. And if a platform has a bigger funnel, that means more subscribers. And if they have more products on the back end, there's more chance for a higher average spend, there's more chance for a higher lifetime value per customer, and more subscribers just means more chances to sell them other things too. So if you listen to how the CEO frames the larger idea, he said Netflix and Spotify reshaped how people access content, including the best content. Now, I will question if the best content is on Netflix. I find myself there scrolling for longer than what I'm actually watching, but this is a big part of their move. They brought better quality content to their channel. He said healthcare must evolve towards a similar consumer-orientated distribution model. That matters because he's telling you how they think at Hims, not as a single product seller, as a distribution platform, and that's a different kind of company. So let's get into the core concept you're really here for. Every Hims product has a lifetime. It comes in hot, it becomes the label people slap on the company, it grows fast, and then it matures. Then the next wave hits. This initial wave drives a lot of buying, a lot of purchases. Then the next wave hits and the label changes again. And they literally talk about this. On the earnings call, Dudham said people used to call them the Viagra company. And that line is funny because it's also serious, because it proves the pattern. In the beginning, the public sees the company through one narrow door. Then the company adds rooms to the house: hair, skin, mental health, weight loss, hormone support, labs, women's health, and now going international. And after a few years, the original label looks outdated. And that is what a product lifecycle looks like inside a platform. Now, the shareholder letter gives you a very clean way to think about product waves. It says they used to target launching one new specialty every year, and each specialty often took years to reach more than 100 million in annual revenue. Then they explained how the speed changed. They say sexual health hair loss required 3 to 4 years to reach that 100 million milestone. Then they say weight loss reached a similar milestone in roughly 9 months. That is a huge statement because it tells you something very, very important. Yes, there's massive demand in the weight loss sector, but the first categories were slower because the platform was still being built. The later categories are faster because the platform already exists. And once you have the brand, the ad engine, the medical workflow, the pharmacy operations, the support team, the subscription system, and the product design, you can launch new specialties faster. And that is what platforms do. They build base one and then they reuse it over and over. Now, if we look at product contribution numbers, so let's use what the company actually disclosed. In the shareholder letter, Hims said this. They said weight loss, men's dermatology, sexual health, and women's dermatology each now generate more than 100 million in annual revenue. They also said the Hers brand collectively is rapidly approaching 1 billion. That is the cleanest byproduct style disclosure they give publicly. They do not publish a full revenue breakdown by specialty in the way people on social media sometimes really demand. So if someone in the comments asks how much is weight loss exactly, the honest answer, Hims does not give a full specialty revenue table, but they did confirm multiple categories are already at 9-figure annual scale. Now that really matters because it proves diversification is very much real. It also proves something else. This company can create new $100 million categories more than once. And there's really 3 key parts to this. Part 1 is how every product wave brings subscribers and revenue. Part 2 is how subscribers stay and spend more because new products keep arriving. Part 3 is how growth looks fast, then slower, then fast again, and why that makes the Netflix comparison so strong. Let's do part 1. So the first thing a new product wave does is create a fresh entry point. A lot of people do not wake up and say, I want a healthcare platform. They wake up and say, I have one problem and I'm looking to solve it. Hair loss, acne, anxiety, low energy, low libido, weight, menopause symptoms, maybe even hormonal disruptions, but it'll be the perceived problem will be slightly different to knowing they need hormones or lab results. Her lab results, they want one solution. That's the door, and HIMS builds doors to this. So then they make the door very, very simple. Quick sign up, clear pricing, no awkward waiting room, and no paperwork nightmare. And also with them partnering with Klarna for their GLP-1s, the friction point to people to get involved in weight loss is much, much smaller. And let's be honest, you don't have to go to a general practitioner, a doctor, and sit in those awkward waiting rooms where everyone's sick and you need to sit around them. Just not a place you want to go spend your time, right? And because it's subscription-based, the first product is not just a one-time sale. It's the start of a relationship. That is the real trick. The first product is the hook. The relationship is the business. Now, if we look at part 2, why do subscribers stay? They stay for the same reason people keep Netflix. Not because they love one show forever, but because new content shows up all the time. You're probably like me. You finish a series, you finish a movie, and then the next week you're just looking for something new. And the reason I've watched a lot of bad movies and also found some good ones on Netflix, probably more bad than good, is because I'm already there. I'm already on the platform. The friction, the ease, the resistance for me to press one button on my controller and have it up there, it's next to none. And then when you're already involved in a company, in a software, in a brand, the friction from point A of I have a problem to looking for a result, it's very minute because you're already in the system. And new products are going to show up consistently with HIMS. As your life changes, your needs also change. And the platform keeps giving you reasons not to cancel. HIMS explains this idea in their earnings call in plain language. They said GLP-1s are one treatment within one specialty, and the platform is becoming more diverse with every investment they make. They also say that as they expand offerings to serve customers as they enter different life stages, they increase their ability to build and maintain deeper and longer term relationships. This is a retention engine because people do not stay because of a logo. They do not stay because of an influencer deal. They stay because the platform becomes useful in more than one area of their life. So here's what that looks like in real life. Someone comes in for sexual health. That solves an immediate problem for them. Then they start to notice hair loss weeks, months, years later. Then they start to notice their skin. Then they start to care about their weight and their sleep. And then they want testosterone support or menopause support. Then they take labs. Now the subscription is no longer one thing. It is their health dashboard. That is why monthly revenue per subscriber rises. If you think about it like a supermarket, we all know probably the best meat you can get is at specialty butchers or butchers that are separate from the supermarket. But why do most of their people buy their meat from the supermarket? Because it's convenient, it's easy, it's there, you're already there. The friction to buy it is there. And that's what I'm speaking to. When you're already in an establishment, a place, a subscription model, a brand, this is when the monthly revenue per subscriber will rise. Just like the average spend per shopper is going to rise when you put a deli or a butcher inside of a massive supermarket. Because as the platform adds more useful things, the average subscriber becomes more valuable over time. And again, HIMS reported $83 monthly revenue per average subscriber for 2025, up 28% year over year. Now, if we look at the third part, the growth curve, this is where most investors mess up. They see a category grow fast, then slow down, and they assume the story is dead because it's not maintaining that trajectory. But in platforms, that's normal. A new specialty often follows an S-curve. Early stage, growth is explosive, then it becomes more normal. Then the next specialty launches and growth speed up again. HIMS is basically describing this inside their shareholder letter. They literally compare how long older specialties took to hit 100 million versus how fast weight loss hits it. That tells you the platform is accelerating its ability to create meaningful new revenue streams. But they also say something important. They say they do not expect every new specialty to scale at the same pace as weight loss. That's management just being realistic. It is a massive industry and there's massive demand in there as well. And multiply with that with the engine HIMS already has. This is probably why we saw 9 months to 100 million in revenue. But they also say they believe testosterone support, menopause, and labs can eclipse 100 million in annual revenue in the future. I believe this. There's a lot more awareness to labs and results and blood work and hormones in 2026. So the story is not every new product is instant. The story is the platform keeps adding new big lanes. Now, if we make the Netflix comparison, when Netflix is launched, people subscribe for one show sometimes, or one catalog or one series. But the magic was that Netflix kept building upon that library. And the bigger the library got, the less likely you were to cancel. So even if one show ended, there was always something next. next. And Hims is trying to build the healthcare version of a library. They even say it in their own language. They talk about entering new specialties, broadening access, partnerships, and expanding global reach. These are library moves. They're building upon their base. Now, if we talk about the unit economics, because platforms only work if the math works, right? Hims disclosed that they maintain target payback periods of less than 1 year. I think it was 6 to 7 months to pay back the acquisition costs of a customer. And that 6 to 7 month payback really matters because it funds the next wave. It means older, mature categories can pay for newer categories. That's what Netflix did too. Older subscribers funded new shows. New shows brought in new subscribers, and the flywheel kept spinning. Now, if we talk about the fall in price again, if GLP-1 prices fall, doesn't that mean revenue per subscriber should fall? Not if volume rises, not if more people can afford treatment, not if the platform cross-sells, not if new categories expand. Hims is basically telling you the same story. They said customers are demanding better access and prices that align with other regions around the world, and they say this as early stages of a new model that works for everyday people. If the model becomes real, lower prices can actually expand the market. And when markets expand, platform often wins because platforms sit at the front door. Now let's ground this in a full year profitability picture. Hims reported $318 million of adjusted EBITDA in 2025. They reported $300 million net cash provided by operating activities for 2025. They also reported gross margin of 74% for 2025 and 72% in Q4 2025. So this is not a company burning cash with no plan. They are investing, but they are also producing real cash flow. So you asked for a framework for how this stock can 10x. Maybe you didn't, but let's look at it over the next 3 years. This is not a promise. This is not a guarantee. This is as a scenario because stocks can go nowhere for years, even when businesses grow, and healthcare has real risks, regulation risks, legal risks, competition, pricing changes. But when people talk about a 10x, they're usually describing two things happening together. The business grows a lot and the valuation multiple changes because the market trusts the business more. So what would have to happen for Hims to have a shot at that kind of move? First, they would need to keep growing revenue at a very strong pace. Now, they've already guided for a full year of 2026 revenue at 2.7 to 2.9 billion with adjusted EBITDA of 300 to 375 million. Second, they would need to keep expanding specialty diversity so the markets stop treating them like a one headline category stock. And they are clearly pushing that. So they say GLP-1s are one treatment within one specialty and only a small minority of subscribers use compounded GLP-1s. Third, they would need to keep raising value per subscriber over time. That's the metric that makes the Netflix story real. And in 2025, monthly revenue per average subscriber was $83, up from $65. Fourth, they would need to keep launching new specialties that reach meaningful scale, and we already have evidence of that pattern. Hims quoted, weight loss, men's dermatology, sexual health, and women's dermatology are all generating more than 100 million annually. So they've shown they can do this. They also said new offerings like testosterone support, menopause, and labs are already seeing strong customer resonance. And they also believe that this can eclipse 100 million in annual revenue in the future. If that happens, you start stacking $100 million blocks on every time they release a new product. And when you stack enough of them, you change the scale of the business. So if Hims is around 2.35 billion in annual revenue today, and it grows to something like 5 or 6 billion over a few years, the market will have to decide what kind of company this is, a risky one product seller or a durable subscription platform with a solid recurring revenue base. And here's why the market could re-rate it, because the company itself is guiding investors towards 2030 targets of at least 6.5 billion in revenue and 1.3 billion in adjusted EBITDA. Now, again, targets are not guarantees, but it shows the ambition and it shows how they want to be valued. If the company executes and the market starts believing the platform is durable, the multiple can rise. That's where big stock moves come from. Not magic, not just a one headline pull, execution plus trust. When people say Hims is a falling product story, they are thinking like this. One product is getting cheaper, so the whole company must slow down. But the Hims model is actually closer to this. One product gets cheaper, more people can afford it, more people join the platform keeps adding specialties, and more people stay. more people buy more. Monthly revenue per subscriber rises, and the business can grow even without price pressure in one lane. That is the difference between a product company and a platform company. A product company needs one hero item to stay expensive. A platform company needs a growing library and a growing relationship. That's why the Netflix comparison is not just a metaphor. It's a business model, and Hims is telling you they're building it. They said it themselves. Healthcare must evolve towards a consumer-orientated distribution model, and their platform puts them at the forefront of that change. Here's what I want you to take away. Hims just grew 28% year over year in Q4, 617.8 million to be precise. While the CEO said GLP-1 prices fell more than 80% over the last 18 months, that is not supposed to happen in a simple product business. It happens in a platform business because platforms don't live or die on one price tag or one product. They grow by stacking specialties, stacking subscribers, and stacking value per subscriber over time. So the question is not what happens to one product price. The real question is this: if Hims keeps launching new specialties that can each become a 100 million plus business, and if revenue per subscriber keeps rising like it did in 2025, at what point does the market stop calling this a one product story and start valuing it like a real subscription platform? We will see. And if you're interested to find out more about Hims, I'm making videos every single day here. You can check out my other channel here as well, because I'll be bringing you about 10 videos a day on this. I will see you in the next video.